Hello everyone. In this video, we will look about options trading and how the options of Bitcoin is being traded on various exchanges, and then we will look dive deeper into the bits of it, and we will see. So first of all, for our understanding, let's see what are the options available for us, and so there are two options available to trade. Uh, that is call options and put options. You can buy and sell both of them, and buying a call option will mean you are supporting and expecting a higher move in the market, while selling the call option will mean you are expecting the market to go down, or you are betting in the downside risk of the market. Now then comes the put options. Buying a put option will mean you are basically betting that the market is going to go down in the short term, or whatever the time period you have been looking at. Selling a put option will mean that you are basically betting on the upside risk of the market, that market goes up in a given period of time. Now, you might be thinking, why not just buy or sell a single contract, just like in futures trading, like just buy or sell a call option, or why not just why have put options for that matter? So let's see. We will understand this concept in a very basic manner. So you all must be aware of the funding situation in the futures market. Like one side pays the price to keep their trade open, and one side gets paid to keep their trade open, depending on the market structure and the exchange dynamics. So like every 8 hours or every 12 hours, you have to pay or get paid to keep the position open. So funding in options trading can be denoted as theta decay. What is theta decay? Theta decay is the technical term for the for a like suppose the market remains sideways, then the options value, or whatever the call option value or the put options value, will decrease over the period of time. So that is what we call theta decay. Basically, it's the funding. But since we have two sides here also, so the buyer of the options and the seller of the options. So the buyer of either call option or put option will always have to pay the theta decay. To whom? To the seller of the call option or the put option. So basically, irrespective of the market movement, the seller of the options will get paid, which is the theta decay, and the buyer of the options, or irrespective of call or put, they will pay some price over a period of time to the seller of the options. So that's why there are buyer and sellers of both of the options, like the call options and the put options. This comes handy when suppose the market is sideways, and you want to bet on the whatever your side of the trade is, you want to bet on that. So an option seller will get benefited when like even if the market is sideways and then it moves in their direction, so there is a win-win situation for them. So now that we have cleared that why we buy sell both of the options, now there is one tricky situation. So like when buying an option contract, your losses or whatever the margin being used in that trade remains limited. Like you put suppose $100 in a trade, and suppose the options price gets doubled, you make $200. And like you bought suppose you bought let's say 24/5 March contract, and 40,000 strike price. It's trading at the option is trading at $1,370, $1,374. So you put $100 in this, and suppose the market hits the strike price, goes above, the option price goes to $2,000. Now your $100 become $200. But for the sellers, so he sold for the $100. Now his running loss is $100. Okay, but the thing is, he will keep losing their money until he closes the trade. Basically, the seller side of the options are on cross margin. Basically, if you want to understand in simple language, the seller side of the options are in cross margin always. Without even selecting it, they are in cross margin. Obviously they can close the trade manually, but when in loss, the whole margin is at risk. that's why what I want you to understand, that their whole margin will be at risk. But when buying the option contract, you don't put the whole account at risk. Like you put a proper whatever the margin you are putting in that trade, and that margin will be at risk when, if even if this $1,200 or whatever, this price goes to zero, the market moves so much against in you that option price comes to zero, then even then you will lose only $100. And suppose that option price hits zero, the seller side of the trade will make only double the amount whatever he has put in. So the potential to gain something is only twice, but they can lose other thrice or even 5x amount of the money they have put in the trade initially. So this is the buyer and seller side of things we have discussed here, and hope it's all clear in your head. Now we will move into some little more technicalities. So next is strike price. Strike price is basically at what price you will be, like whatever, suppose you are longing right now 38,000, the price is around 38,000 here at this point. So you are thinking, I think in 1-2 days, 3 days, the market will be around 41,000, and that's basically what you are expecting your target price. All right. So for now, suppose, as you can see, these are all the in the money options. In the money options are always high priced because you are already that price is priced in, and you are buying that option. So you are already placing a very safer bet. So that's why you can see the price of these options are very high, and when some market moves opposite to this direction, suppose you bought a call option for $2,200, 38,000 strike price, you are in the money, and once you are in the money, the theta decay will also be less or almost negligible. But suppose the market dumps on you and the price is now 35,000, then the losses will be very heavy. So for the buyer of the options, buyer traders, like whatever the call option or the put option, there is a suggestion that look for the out of the money calls, like you want to hedge your futures trade or hedge your spot trade and whatever. That at that moment you have to look for the out of the money options to get into the trade, because you will get it cheaper, and if the strike price hits, the profits will be immense. So that's why the term, hope you understood the term in the money and out of the money. Like the price, if the sellers are like buyers of put options are in the money above the 39,000, and the buyer of call options are in the money below 38,000. And these are all out of the money options for the call option side, and these are all out of the money options for the put option side. So like if the out of the money price is reached, then the profits are very immense, and once the price is reached, there will be lesser amount of theta decay if the market goes sideways after that. So strike price is, coming back to the strike price topic, strike price is basically from which point you will be in the money. Like suppose you chose 41,000 strike price and the price goes above 41,000. So now you are in the money, and now there will be less theta decay, and if you close around 41,000, there will be a good amount of profit for you. And similarly, same goes for the put option sides. Now we will look at the expiry also. So how expiry affects the price. So these are weekly contracts. The next is expiring in 9 days. This is 18th March. It is expiring in 2 days. So basically there are multiple options expiry for available to trade, like 1 day, 2 days, and these are weekly expiry. There will be right after that you have 7 days leeway here. So expiry is also a very tricky part, plays a very tricky part in the trading of. As closer you get to the expiry, your options will start to theta decay in a more in a high there will be more theta decay in your options as it goes close to the expiry. So we will see. And also there is one more thing. So if you bought the out of the money options and your expiry is getting closer, then the price will also be reduced, like because of obviously because of the theta decay. So for scalping, you are scalping for a simple intraday move. You have to be mindful that you take the out of the money options and use around 2 days expiry, and you take out of the money options and do the trade. So here you can see it is $829 and $500 for the 40,000, but the 25 March contract is almost double, trading at the double price, or even I think it's triple the amount of what it is for the 18th March. Yeah, so you can see here. What I will suggest is to gather more exposure for the markets, for the options trading. Slowly we are also launching a full-fledged crypto course, options trading course on our channel. Slowly every 7 days or every 5 days there will be one episode. You will learn new strategies on how to trade them, and how to protect your positions, how to there are different strategies, how to farm the shortest straddles, longest straddles, how to do those. And then there is hedging of your futures position or your spot position. If you want to hedge, like suppose you are in a futures trade and now suddenly something like Russia invading Ukraine happens, so you are unsure about your position now. So what do? Like you either take the running loss on your futures trade, on your spot trade, and or you can hedge your positions via option contract, which will require very less margin, and the position size will be almost same of your futures trade. So that's how you hedge the position. We will go into detail of that in the next episode, but for this video I hope you guys understood strike price, out of the money, in the money pricing, and expiry date of the options. You understood what is call options, what are put options, and how to what is theta decay, and why people buy, why are people a buyer of options, or why people are seller of the option. If there are any doubts, you can comment below, and we will look into your comments. There will be a link to this website bit.com. It is the second most highest volume website for the options trading after obviously Deribit, and they have a very nice affiliate system going on. Like not everyone will get you that affiliate link for now, but I have partnered with them and I'm currently working as the ambassador for them. So this whole course has been organized from their side, and I will be delivering it to you. So there will be a link for the bit.com sign up. You can get up to 40% of the trading fees discount, not just on options, also on futures trading and also on spot trading. So a 40% discount on trading fees is very lucrative. So I will suggest you all to sign up right now via the link given in the description as well as in the pinned comment section. So please check them out and support the cause. Like there will be more episodes coming every week obviously, and there will be articles published on how this trading and how it will progress. So see you in the next episode of this course. So till then, do the sign up, and queries will be addressed in the next video. So do comment your queries or whatever you haven't understood. So I will take your leave from here and see you in the next video. Thank you very much.